Okay, so last week we talked a little bit about merchandising companies. That's companies who sell merchandise or goods to people, as opposed to service companies that only sell services. In reality, there are true merchandisers and true service companies, but most businesses do some of each. Think of someone like Walmart, who's primarily a merchandiser, but you can also go there and get your oil changed or your tires rotated, or they have some service things that they sell as well. Anyway, and so some of it was a little bit confusing, especially all the stuff with like returns and allowances, right? That was probably the more confusing part of the chapter. Um, Here we get into we're kind of further looking at these kind of businesses, and we start to have this issue with inventory, where sometimes we don't purchase like inventory and then sell all of it and wait till it's all gone before we purchase more inventory. It's pretty normal for us to purchase inventory. You could have inventory sitting on a shelf to sell that you've paid three different prices for because you've made three different purchases, and then they get mixed up because customers like will grab ones from the back or from the whatever. And so the question is, if I paid three different prices for merchant or for the inventory, how do I know what the merchandise inventory cost me when I sell it to record it as cost of goods sold? Um, and the easiest one, there's a style of inventory management that's called specific inventory, or the specific cost method. And that's usually used by businesses that have really expensive inventory, say someone like a car dealership. So every car has a unique identifier, the VIN number of the car, right? And so you can know exactly what you paid for that car and then exactly what you sold it for. And you can easily calculate the sales revenue, the cost of goods sold, and then the gross profit on each car. But when you have a bunch of small products, again, think of like a Walmart that's got cans of peas and cans of peaches and cans of soda. And I think if you go into a Walmart and you just look, the sheer number of items they have to manage and keep track of is insane. And that's in just one store. And then they do that times hundreds and hundreds of stores. And so it just doesn't make sense. Let's say they have cans of peas on the shelf, and some of those they paid 50 cents for, and others they paid 52 cents for because the market shifts and what the supplier provides them for. It doesn't make sense for them to keep track of the cans separately and be like, okay, that one we sold was a 52-cent can, and that one we sold was a 50-cent can. So instead, they'll use one of these three cost flow assumptions that I have up on the screen right now. And what we use this for is just to figure out what our cost of goods sold is and to figure out what the cost of our remaining inventory is. Okay. So the first cost flow assumption is called first in, first out. That assumption assumes that the first inventory I buy is always the first inventory I sell. Okay. Um, and then the second is called last in, first out. This one's more rare. In fact, IFRS, International Financial Reporting Standards, don't even allow businesses to use last in, first out. But in the US, GAAP, which is what we use, generally accepted accounting principles, it does allow for this. So we have to learn about it. So last in, first out assumes that the most recent goods I purchased are the ones I'm selling. This is often used by tech retailers and things like that. So like think of an Apple store where most likely they're going to be selling like the new version of stuff as soon as they get it, and the old stuff will kind of sit unless someone specifically wants that. And then the final one is called the weighted cost or weighted average cost method. And this is where instead of trying to assume it's the first in, first out, or the last in, first out, we just do an average and it comes out somewhere in the middle of the two. So these are the three ways that businesses will make an estimate or an assumed cost for the goods they sell and an assumed cost of the goods still sitting in inventory. Okay. So in this example, a company sells one item we can say that it purchased one of this item on May 10th for $9. On May 18th, it purchased another one for $13. And on May 24th, they purchased another one for $14. So then we're selling it for $20 to a customer. And the question is, unless you kept track of it, which one should I assume I sold? That's really what the question is, okay? So with the first in, first out method, you're going to assume it was the first one you purchased. So you'll see that that $9 goes to the cost of goods sold, giving them a gross profit of 11. And then on the balance sheet, the inventory account will have the other two items that you purchased still there. So the first in, first out method assumes oldest one is the one we're selling. Newest ones are still there in inventory at the end of the financial period. With last in, first out, we would assume the newest one is the one we sold. And the two older ones are the ones sitting there in inventory at the end. So here you'll see the sales is $20. The cost of goods sold is 14, giving them a gross profit of 6. And then what's left on the balance sheet is these two older ones, $9 and 13, giving us $22 in inventory. And then with the weighted average method, what we do is we add up everything we have in inventory at the time of the sale. So the 9 plus the 13 plus the 14, we divide by 3 to get an average cost, which comes out to $12. And then we say 20, we use that as our cost of goods sold. 20 minus the 12 gives us $8 in gross profit. And since our average cost was $12 per unit and we still have 2 units in inventory at the end, we take 2 times that average cost to get us our ending inventory. Okay. So again, if we have a situation where we can specifically identify what inventory we sell, like in this situation in real life, if we only had 3 items in inventory and we sold one of them, it'd be pretty easy for us to, like, we could just write the date we purchased each one on the bottom of the can or something. I don't know what they're selling, or on the bottom of the box. But in real life, most retailers are selling massive quantities of stuff, and it just doesn't pay to like keep track of all of that separately. So probably the most common that you'll see in most businesses is first in, first out. It's the most logical because we tend to stack our shelves with the newer stuff on the outside. If anybody's ever worked in a retail business, it's called facing the shelves. You move all the new stuff forward, put old stuff behind it, and you try to sell the first in, first out. So only a business that has a very specific business model where they really do think they're going to be selling the newer stuff first would ever use last in, first out. It's quite rare. You don't see it a lot in real life. And then the average method is fairly common too. I actually prefer that one. I think it's the most conservative method because as prices go up and down of my stock, to take the average is just the more, it's like, it's conservative. It's an estimate right in the middle of everything. All right. So we're going to look at this as an example using the same data here. So we're going to look at all 3 of these inventory costing methods. So here's our information. On January 1st, we had 1,000 units in inventory that cost us $20 a piece. Then on January 4th, we sold 700 units for $30 each. On the 10th, we purchased 500 more at $22.40. On the 22nd, we sold another 30, or sorry, we sold 360 at $30 per unit. On the 28th, we sold 240 units at $30 per unit. And then on the 30th of the month, we purchased another 600 units. So we can see our costs are going up. We're selling at the same price each time, regardless of that, which is pretty normal. We're always selling them for $30 to our customers, even though our costs are fluctuating. All right. So to do this first in, first out, if you wonder why I'm sitting over here instead of moving like I usually do, it's because I left my little microphone that I used to record these fell out of my bag. Sad. So I'm recording on the microphone on the camera. Sorry. You're like, we don't care. Your pacing just is weird. It doesn't actually help us learn. All right. I like to believe I'm helping people learn. All right. So here is This is a little confusing to look at, but this is like an inventory, I don't know, tracker sheet. And you'll see it has the item number up there in the corner. And they have like one big section for purchases, which will have quantity, unit cost, and total cost. A big section for cost of goods sold, which will have quantity, unit cost, and total cost. And then the section for inventory, so which will have those same piece of information. So we know it told us that there were 1,000 units in inventory at the beginning of the month with a unit cost of $20 a piece. So that means the total cost of that inventory is $20,000. That's our inventory as the month starts. On January 4th, we make a sale. We sell 700 units for $30 a piece. So over here, you can see the journal entry. 700 times $30 is 21,000. And so our accounts receivable and sales are going to be impacted by that retail price, the price we're selling it to the customer. And then our cost of goods sold and inventory will be impacted by the cost of the items. Remember, we're going to assume it's the oldest units. And at this point, it's the only units we have. So we sold 700 units for $20 a piece. So our total cost of goods sold was 14,000. And we have remaining in inventory 300 units at $20 a piece with a total cost of 6,000. Then on January 10th, we purchased 500 more units, but they now cost $22.40 a piece. So you'll see when we get over here into the inventory column, they have to keep them separate. So right now we own 300 units that cost $20 a piece, 500 units that cost $22.40 a piece. And now when we make our next sale, this would be the point at which we'd have to ask ourselves, well, like, which units are we actually selling? Is it the ones that cost $20 a piece or the ones that cost $22.40 a piece? And on this first one, we're doing the first in, first out method. Okay, which means we're going to assume that we sold. So if we sold on the 22nd, 440 units, we're going to assume that we sold all 300 of the $20 units. Oh, I'm sorry, we sold 360 units. We sold all 300 of the $20 units and then an additional 60 of the $22.40 units. Why? Because the $20 units are older, so we're going to assume those sold first. And then the $22.40 units are newer, so we're going to assume those sell second or last in this case, which means we're left with 440 units, all at a cost of $22.40, which gives us a total cost of $98.56. On the 28th, we sell 240 units. The only units we have in stock right now are the $22.40 units. So we sell 240 that cost us $22.40. And we're left with 200 that cost us $22.40. Then on the 30th, we buy 600 units that cost $23.30 a piece for a total cost of $13,980. And when at the end of the month, we have 200 units that were $22.40 a piece and 600 units that were $23.30 a piece. So with first in, first out, each time we make a sale, we're saying, which ones did we sell? Well, we sold the oldest ones first. That's really the only tricky part about this once you get used to it. Okay. So we're keeping the units separate by their cost or by when we purchased them. And then when we sell them, we're selling the oldest ones first. The first in, the first ones we purchased, are the first ones out. That's all. Okay. All right. So let's take a look at the first question on the homework or the guided. So it says the following units of a particular item were available for sale during the calendar year. January 1st, we had inventory 4,000 units that cost us $40. Then we have a sale, then we have a purchase, then a sale, then a purchase. So what they want us to do is kind of complete this inventory record. All right. So we're going to start with January 1st, and we're just going to put This is our beginning inventory, 4,000 units that are $40 a piece. Sorry, this is kind of giant, so we have to scroll. So 4,000, $40 a piece. And then to find the total cost, we just multiply them. If I had 4,000 units that cost me $40 a piece, that would be, is that right? Right. Thank you. So that's my beginning inventory, right? That's what I'm starting the month with. If you picture it in real life, you have like a storeroom or a warehouse or something, and there's 40 units of something sitting there, 40 items, and each one of them cost you $40. I'm sorry, there's 4,000 items sitting there. Each one of them cost you $40. So you have $16,000 of stuff sitting there, and that 16,000 is at its cost, what it cost you. Okay. So then on April 19th, we had a sale and we sold 2,500 units. So we're going to come over here under the cost of goods sold section and say 2,500 units. And how much were the units? How much do the units we sold cost? $40, because that's all we have right now, right? Is units that cost us 40. And then 2,500 times 40 should be 100,000. So I'll double check my math. I'm not too proud. All right, so what's left in inventory? Yeah, how'd you get that? Good, so you had 4,000. You sold 2,500, so 4,000 minus 2,500 is I have 1,500 units. Whoops, still sitting in inventory, right? They still cost me $40 because that's still the only units I have. So I have $60,000 worth of units at their cost still left. Now we're going to make another purchase. June 30th, we purchase 4,500 units at a cost of $44 a piece. And 4,500 times 44 is $198,000. So now on our quantity, then we're going to say, and we always keep them in this order, okay? In with the oldest one listed first. So I have 1,500 units that cost me $40 a piece. And then I've got another, what did we say it was? 4,500 units that cost $40 a piece. So in my inventory right now, I've got a total of 6,000 units, 1,500 of which are the older ones that cost $40 a piece, and 4,500 of which are the newer ones that cost $44 a piece. That's what's sitting in my inventory now, sitting there in my warehouse. Okay. So then on September 2nd, I sell 5,000 units. The question is going to be, well, which units did you sell? Did you sell the older ones or did you sell the newer ones? And since we're using first in, first out, we're going to assume we always sell the older ones first. Okay. So I sold 5,000 units. I only have 1,500 of the older ones. So I'm going to assume I sold all 1,500 of those plus 5,000 minus 1,500 is 3,500 of the newer units. Cost of the older units was 40 per unit. And the cost of the newer units is $44 a unit. for 154,000. And how many units do I have left? So I sold all 1,500 of these, and I sold 3,500 of these. So I must have 4,500 minus 3,500, or 1,000 units left, right?
Mhm.
And which units are left? The $44 units, right? Because I sold all of the $40 units plus 3,500 of the $44 units. So all that's left are 1,044 units. And even I can do that one in my head. 44 times 1,000 is 44,000. On November 15th, I purchased another 2,000 units, this time at $46. So now at the end of the month, or I mean, after that purchase, I still have 1,000 of the $44 units plus 2,000 of the $46 units. So at the end of the month, I can figure out my total cost of goods sold just by adding up this total cost column. I have 100,000, 60,000, 154,000. So 254 plus 60 is what, 314? That'll give me my total cost of goods sold for the month. And then it's a little tricky on the cost of inventory because people always want to add up this whole column, but that's not right. Instead, we just add up the amount that's in this last entry, right? Because that's how much inventory we now have. We have $1,044 units and $2,046 units. So total, we have 44,000 plus 92,000. It's 136,000. You could see that it'd be relatively easy to make a math error in all of that, right? And that they're interconnected, meaning if you make a math error up high, then they're all going to be wrong down below it. So that's just how life is in accounting. Okay, so any questions come to your brain as we went through that? There's two reasons there's no questions, right? There's one is everybody was like, I totally got it. The other is people are like, I don't understand it well enough to even formulate a question about it. So I'll assume that we at least got it well enough to move on. Yeah. Yes. All right. You know what happens when you assume? Yeah. I do that all the time. So that was first in, first out. All that means is we assume the first inventory purchase is the first one we sell. So let's look at the same example numbers that we did for first in, first out, or last in, first out. So again, they start the year with 1,000 units at $20 a piece. Then on January 4th, they sell 700 units. It's easy when all the units you have are all the same cost, right? Then there's no having to figure out what was first or what was second because it's the only ones you have to sell. So they sell 700 at a cost of 20, meaning the cost of goods sold is 14,000. And they now have 300 remaining at a cost of 20 for 6,000. Then they make a purchase on the 10th. They buy 500 at a cost of 2240, giving them a total cost of 11,200. And now they have 300 that cost 20 and 500 that cost 22.40. So when we did first in, first out as an example, and now last in, first out, to this point, it's exactly the same. There's been no change. Why? Because on the first sale, there was only one inventory type in there, and it was all the $20 ones. But when we get down to the sale on the 22nd, now's where it's going to be different. Because now we're going to assume last in, first out, meaning the ones we sold are the most recently purchased ones or the newest items to come into inventory. So if they sold 360 units on January 22nd, we're going to record 360 units, and we're going to look at our inventory up here and say, what's the newest ones? It's these, these $22.40 ones. So we're going to assume all 360 we sold were from, there's only 500, so we sold 360 at a cost of to us of $22.40. And then what we have left is still the 300 that cost 20 plus 500 minus 360, which is 140 of the $22.40 units. So the only difference is we're assuming instead of the first units that we had were sold, now we're assuming the last. That's all. It's easy to get this. The reason I keep like repeating this so like rigidly is because it's pretty easy once you get accustomed to it, but it's like easy to get confused when it's brand new. Okay, that's so if you wonder like why is he repeating it over and over? Because I'm annoying. Okay, on the 28th, they make another sale, this time of 240 units. So again, the question, well, which ones are we selling? Well, we're going to sell the newest 140 first. So those are the first ones we're selling. And since we sold 240 total, we must sell another 100 of the older $20 units. What's left over? Well, 200 of the $20 units. Finally, on the 30th, they purchase 600 units at $23.30. So now what they have left in inventory at the end of the month is 200 of the $20 units and 600 of the $23.30 units. We add up the total cost of goods sold, and we add up just the last two, just what the balance of our inventory is on the last day of the month to get our total inventory value. Again, that's another area people like often mess up because they just think, oh, total the column. But it's really only what's the cost of your inventory at the last day of the month. All right, so let's do an example of last in, first out. Sometimes people call first in, first out FIFO or FIFO. You'll hear people call it both. And with last in, first out, they call it LIFO or LIFO. I think they all sound dumb. So I say first in, first out, and last in, first out. But you can do whatever you want because you're adults. All right. So here's a following situation. Looks like it's the exact same numbers we had before, but now we're doing it last in, first out. So again, at the beginning of the month, we had 4,000 units at $40 a piece. That was easy enough. On the 19th, we sold 2,500 units. Which ones did we sell? Well, we only have units of one cost, so we sold $40 units. And if we had 4,000 and we sold 2,500, we now have 1,500 left. Yep. And that is 60,000. So again, that's identical to the last one we did up to that point because we only had one group of inventory. But then on the 30th, we purchase 4,500 units at $44 a piece. Forgot the number. $198,000. So now we have 1,500 units that cost 40. And we have, what was the number? 4,500 units that cost 44. So now we're ready for a sale, right? And when we do that sale, we'll use last in, first out. So on September 2nd, we sell 5,000 units. So if we use last in, first out, we're going to assume that we sold all 4,500 of these newer units, plus another 500 of the older units to get to our 5,000. So I'm going to say 4,500 at 44 and 500 at 40. Whoa. What do we have left over after that sale? 1,000 of which units? Right. Right, because we sold all 4,500 of these newer units that were $44, plus we sold 500 of the older units, leaving us with 1,000 of the older $40 units. Am I going too fast? Good. Okay. What was that look? Quants? It felt a little mean. I'm not sure how to take it. All right. You know, first day I thought I would never looked at you and thought bully, but now I feel like you're bullying me a little. All right. You can't actually joke about someone being a bully anymore because bully is a really bad word, right? All right. November 15th, they purchased 2,000 units for $46 a piece. I'm joking. You're a great person. I don't even know you, actually. I know nothing about your life. So 2,000 units, that would be what, 92,000? What do we have left in inventory at the end of the month? We've got 1,000 of the 40s. And 2,000 of the 46s. So our total cost of goods sold will be 100,000 plus 198,000 plus 20,000. And the total cost of our ending inventory is just whatever it is at the end of the month. So 40,000 plus 92,000 or 132,000. If I made a mistake, looks like we're all good. We good to move on? So you were still looking at it, trying to get it finished. Yeah, give me a second. Where's it at? All right. So the last method I mentioned was the perpetual, or sorry, the weighted average method. And so this one, again, January 1st, we have 20 units. That costs, or sorry, we have 1,000 units, cost us $20 a piece. So the total cost is 20,000. Then we sell 700 of those. So the cost of goods sold was 700 times 20 or 14,000. And then the remaining inventory was 300 units at 20. But here's where it gets different. Okay, so this is the part you're going to want to pay attention because it's different. So then on the 10th, they purchased 500 units for 22.40. So what we do is we add the quantity. We had 300. Whoops. I'm clicking on it. We had 300. We purchased 500 more. So that's going to give us a quantity of 800, makes sense. And then we're going to take the total cost of the units we had in inventory, which was 6,000, add the total cost of the new units we purchased. So that's going to give us a total cost of 17,200. And then to find the unit cost, we're going to divide the total cost of 17,200 by the total number of units of 800. And that's going to give us an average total cost of 2150. So with the weighted average method, we recalculate a new average cost each time we make a purchase. Then we apply that cost to any sales transactions that occur after that. And then when we make a new purchase, we recalculate the average cost. Okay. So then when they make their sale on the 22nd of 36 unit or 360 units, they're going to use that average cost they calculated here. They're going to say we have 360 units times 2150 gives us 7740. And then our remaining inventory is 800 minus 360 or 440 units times that average cost. They'd use the same average cost on the sale on the 28th. And then when they make the purchase on the 30th, they say we have 200 units plus 600 units gives us 800 units. And the cost was 4,300 plus 13,980 gives us a cost of 18,280. Divide 18,280 by 800 to come up with the new average cost. So that's the process of doing this. Okay, we'll do an example one and you'll see it a little better. Whoops. All right, so use the weighted average cost flow method. Again, same information. So our beginning inventory, 4,000 units at a cost of $40 a unit. So a total cost of 16,000. Same as the other two, right? Then they make a sale of 2,500 units. Again, the only units we have are $40, so that's going to be our cost. And we have left, if we had 4,000 and we sold 2,500, we have 1,500 left at a cost of 40. Whoops. So again, that's the exact same as we did before. But now when we make a purchase, we're going to calculate the average cost. So right now we have 1,500 units and we're purchasing 4,500 units. So if I had 1,500 and I purchased 4,500, I'm now going to have a quantity of 6,000 units. Right? Because I had 1,500 and bought 4,500 more. The unit cost of the units I'm purchasing is $44. 4,500 times 44, was it 198,000?
Yeah.
So we're starting to have done it enough times. I'm going to come over here and I'm going to say I had units that were 60,000 plus I just purchased another 198,000. So 60,000 plus 198,000. My new cost, total cost is 258,000. So all I'm doing when I make a purchase is I'm taking the units I had plus the number of units I bought to give me total units, and the cost of the units I had plus the cost of the units I purchased to give me the total cost. And then I'll find my unit cost by taking an average. I'll just take 258,000 divided by 6,000 units. Gives me an average cost of $43 per unit. And now I'll use that average cost for any sales I make until I make more purchases. So I make a sale on September 2nd of 5,000 units. For the cost, I'll use $43 because that was my average cost. So 5,000 times 43 gives me $215,000 is the cost of goods sold. And what I have left is 1,000 units at a cost of 258 minus 215, $43,000, which still has that average cost of $403 a unit. On the 15th, I'm going to purchase 2,000 more units at $46 a unit, which was $92,000. And again, to figure out my average cost, I'm just going to say I had 1,000 units. I purchased 2,000 more, so now I have 3,000 units. And the cost of those 1,000 units was 43,000, plus the cost of what I just purchased at that was 92. So 43,000 plus 92,000, oops, is 135,000. And then to find the average cost, I just take 135,000 divided by 3,000 units. Let's say my average cost is now $45 a unit. At the end of the month, I could add up my total cost, which is 215,000 plus 100,000, so 315,000. And you'll notice here that they want us to do to just bring down all of it. So the quantity of 3,000, the unit cost of 45. So these are the three methods that most often get used to estimate your cost of goods sold and the cost of your remaining inventory when you can't keep track specifically of which items you sold, which is most big retailers that sell a bunch of low cost items. It's just not worth it being exact. Probably when you started accounting, you thought it was always about being exact. And now you're seeing that often we use estimates when it just doesn't make sense as far as sheer dollar amounts to try to keep track of everything specifically. Let me figure out who I'm missing since I didn't take roll. Is he the only one? Everybody else is here? Terrific. Okay. That's all I have for you today. 4 minutes early. You're welcome. Consider it a gift. What will you do with the 4 minutes I've given you today?